So many aspects of real estate that are kind of, one-sided. Let's be honest. I mean, there's a lot of things in real estate where it benefits, the person who's got the most money or the person in charge of the deal. But what's cool about you is you're not just benefiting yourself, you're or the lenders, you're benefiting the end home buyer, the end person, the one that really, if you really think about it in today's dynamic with high interest rates, very, very, limited supply, they're getting pinched. It's almost like it's by demand. I'm not going to lie. Like when you really look at it, where's the wealth in this country? It's middle Americans, right? It's their homes. That's the wealth. Yep. And what's happening right now is squeezing that. You saw what was happening with iBuyers many years ago. Now that, in the hedge funds, the BlackRocks, the Blackstones are coming in, buying neighborhoods, pinching out the average American, the middle American that really relies on real estate as being their wealth. And now that dynamic, it seems to be switching. So I love that you put the power back in the person who normally doesn't have the power, and that's the homeowner. But the other thing that you mentioned is our path being similar. And gosh, I mean, I flipped over 270 houses. I think I hated 269 of the 270 that I flipped. That transactional business will put you in the grave. But, when I was doing that, I was borrowing money. I was always the borrower, and the lender always made more money. In very rare occasions did I make more than the lender did. And, one of my friends, Greg, who was just my lender then, he said to me, Chris, the ultimate in real estate is being the bank. And it's like you, dude, he said that. And I'm like, all right, well, Greg, when I get $1 million to $10 million in net worth, great. I'll be the bank too, like you. And I can just be like Greg. But, I missed so much. I missed so much because I thought it was all about having the resources when it was about actually what you do, being resourceful. So let's talk a little bit about how you create these opportunities that are win-win.
Yeah. So one thing that you said, so like my end result is finding a deserving homeowner a homeowner that deserves homeownership. They have a down payment. They have proof of income. They have the ability fully underwritten, just like any Wells Fargo, Bank of America, Chase Bank borrower. That's our end user. That's our end result, right? But right now with our economy is how many, and this is what one of my goals are this year. It's like, how do I get the information out that says, okay, everyone that received that signed on the dotted line for a mortgage in the last, 15 years, let's say, and let's just go a year back, have all signed at sub 4% interest. Okay. Well, today, what are we, October 20th, 21st, I think. It's 8% interest 20, now.
Yeah.
It's 8%. Okay. Well, how many people do you know? And I know the average consumer, they should never, ever, ever, ever get rid of that mortgage. People don't understand that there's a way to keep that. There's a way to keep it in place. There's a way to structure it. There's a way to make some cash flow. There's a way to get some upfront cash. And there's a way to arbitrage that and create homeownership for somebody without being a landlord. Obviously, that's why I'm wearing my landlord shirt today. The average consumer should understand this process because it's the biggest game changer that they'll ever have. It's that one mortgage that they signed on over the last 10 years that they're like, okay, I need to move now. I need to move. Well, okay, great. Now, if you do move, I have this asset. Do you want to be a landlord with one house in Phoenix, Arizona? I got to move to like North Carolina or whatever. No. And so my goals now is I really trying to educate people and understand. Great example. I'm buying a house the next week. It's $550,000. It is the top of the market. Okay. In this specific area. But guess what they have? They have a $272,000 mortgage at 2.875.
Wow.
Okay. So think about them. They have 200 plus of the hard equity that they need to go move to a different house, which they've already done. And I'm like, what if I gave you all of that? And then I get to take over your payment. Maybe I take over your payment, give you some cash flow. Now I'm giving them the cash. Then I just wrap it up in a bow, and then I can provide home ownership for someone who deserves it, but isn't able to go get that conventional loan, right? And so they're like, no, we can't do that. The agent's like, no, we can't do that. I'm like, no, you can do this, and this is how. And they're like, oh my God, this is fantastic, right? So I was just back of the napkin. I'm like, oh my God, this is the seller's going to win. They're going to get some income. The buyer's going to win. My investor, where the heck do I come up with 200,000 cash if I'm doing this all the time? Private money, right? Well, I can even right now in a traditional CD is like what, 5% or whatever, right now, I could pay someone double that and still secure it and create this win for like 3 or 4 different people. Oh, the realtor's now going to get paid. So, I mean, I'm not going to go, I'm not going to go through all the math. There's 4 or 5 people that's getting paid on this one deal. And I'm in there too. Right. So
you're feeding cool. A bunch of families, man. You're feeding a bunch of families. Hey, listen, let me pause real quick and transition, because there's an interesting thing that I think fits perfect with what you're just saying. So, we have this office space here. It's 8,000 square feet. We've been here for 6 years, but we knew we were on bought time because it's a mall. It's a mall that's being completely tore down and redeveloped. So, we got the notices that most tenants had to be out by December, and I had to be out in the springtime. So I was going to, do a couple things, and I found a building. But I kept like passing on this building. It's right by my house. It's freaking beautiful. It's everything we need and then some. And I kept passing because, the owner, who I know very well, he's in my neighborhood, wanted too much money. So I don't know if it was what I was watching, but I just got this idea. I'm like, I can make this deal happen. So we started talking price, and he said, I can't go below this. So he had a number, right? Which was about 175,000 more than like my top line number. And I said, listen, like, you're way too high. I need you to get an appraisal. He got an appraisal, and it appraised at 755, and he wanted 925. So most people would be like, we're never going to close that gap. Here's what I did. I went to him and I said, listen, there's 2 ways we can do this deal. Number 1, we agree on a price, which doesn't seem like we're going to get there. Or number 2, we work on the terms. So how I put the deal together is I literally made him hold a large portion of the mortgage, okay, for a period of 12 years. And I'm going to get to the 12 years at 0% interest. And then I would pay him his price. So how did I come up with 12 years? Simple. I ran mortgage amortization schedules. I looked at how much money I'd give away to a bank at today's rates, which, I called my banker and he said about 7.7 to 8%, right in line with you, is what I'd pay. So I said, all right, I know mortgages are heavily loaded. You lose to the velocity of interest in the early years. So in 10 years, I figured it out. If we were to finance that money at a bank, here's how much we'd give away to the bank in interest, which was way more than the difference between what it was he wanted and what I was willing to pay. So I literally ended up buying the building for less than I would have, not for purchase price. Purchase price is more than what most people would pay, but because of the terms, I just all I'm doing is I'm shifting who's getting the money. This guy's my friend. I want him to get the money. I don't want the bank to get the money. I don't like banks. I teach people how not to go to traditional banks, how to be their own bank. So literally by paying him the interest or a portion of the interest I would have just given away, I made the deal happen, and I get to move in really quickly. So it's kind of like what you do, but you take it like 3 layers deeper. But I just figured, like, just putting it in perspective, there's so many ways to do this. And this is just one office building that
you just took the price of, let's just say 7 and 9 that he wanted. And you're like, I'll give you 9, but I need these terms. Mm-hmm. And basically, if back of the napkin amortization that you are now paying 0%, you're like, I'm just going to front load. I'm going to give you what you want, front load the interest up front, give you a little bit of down payment. The best part is now he has a 0% interest loan locked in with you for X amount of years,
12 years,
10 plus years, right? And I don't know how old he is, and this isn't the business I'm in. But I know how there's a chance him or his estate are going to want, they're going to want there's going to be a liquidation event, especially between now and 12 years. It's just happening. So when you structure that, just make sure you put first right of refusal to buy your own note, because if he goes to market on a 0% interest loan, what do you think that loan's really worth in the open market? Yeah, at least half.
Yeah, exactly.
So you just basically created. Now, if it doesn't, who cares? It's 0%. But if it does, they're going to come to you and go, hey, we got an offer on this note. We had a liquidation event. Do you want to buy it? And it is what it is, or just leave it. It just gives you control, right? It's like control versus own. And that's what the banks do. And so it's just having like, my brain, that's how I think. And then, people don't even, and the structure of all this stuff is where the wealth is. Like that building you have, it's a win regardless of what happens. But if something else happens, you're going to provide an opportunity for them to liquidate if they need to. And no one's going to pay more for that note than you, because you're in the house, you own it. You know what I'm saying? So pretty cool thing. But yeah, like you and I were talking about where the market's going right now, and these 30, every mortgage has been a 30, at least a single family mortgage. And we were even talking about SBA loans, but they're 30-year fixed. Okay, well, rates are at 8 now. I mean, there is no better time in the history of our planet to like really get in control of this cheap debt. And there's paperwork and structure to do it. And that's what we do. Like, that's what we do. That's what we teach. That's what we do every day. I mean, even that one deal I was just telling you, the 550 deal, I'm still going to make 700 or 800 in cash flow. My investor's going to make probably 1,200, 1,300 a month in cash flow. The seller's going to make a few bucks. And then when it's all said and done, if this thing balloons out in 10 years and just goes away in 10 years, I think it came out to like, because of the cash flow and the amortization pay down on the 3% loan, 2.8 versus what I'm charging my end buyer, it comes out to like $310,000 profit, like on one house that's over market, just like what you did with yours. It's unbelievable. And that's just one $500,000 single family home in America, and that seems to be the median home price now. So they're everywhere. It's just how to structure it, you know? And so, yeah, that's going to be a very fun time in our market. I have realtors coming out of the woodwork. If you're a realtor, you have to know this stuff or you're going to get lapped. And not only lapped, you're going to change a lot of people's lives because of it, because you know how to structure this stuff. You're going to make your sellers rich. You're going to become you're going to make some money, and then you're going to help homeowners, and buyers create homeownership and without a ton of stress, right? Because of the landlord model.